Hello. And so continuing on our discussion on the styles of investing, today we are discussing, how you should evaluate a particular style of investing. And essentially, any investment strategy, one needs to understand that where the returns are coming from, right? And once that fundamental basis of what is the source of returns or source of alpha, excess return over the broader market benchmark, if you understand that well, then it is much clearer to kind of make an opinion about how a particular strategy is going to work in the future. And this is what we are going to discuss today. So because we have done analysis of our scientific investing style of investing over the last 8+ years, and we have looked at various factors. But before we jump into what drives returns in scientific investing, let's just broadly discuss what essentially drives return in an equity portfolio.
So there are three factors, right? There is the yield, which is the free cash flow to the enterprise value, right? So yield, but for a very crude way of understanding is inverse of P. So E by P instead of PE, right? So E by P, or correctly speaking, the free cash flow yield plus growth plus re-rating or de-rating, right? Either the portfolio will re-rate to a higher multiple or to de-rate, right? And these are the three factors. But normally when you talk about growth investing, you're just focusing on the second factor, which is growth, right? Earnings growth. And you just focus and think about that.
Right.
And that's what drives return there. That is the focus. If you talk about value, then it will be about possibly some re-rating, right? Or mostly it's actually about yield. That how much yield you are getting, right? And many times it's dividend yield, like more or less everything is paid out as dividends in a lot of value stocks.
Right.
And that is all you get, right? And other factors are less relevant. Or you go to
maybe quality, where you believe that it's a compounding engine, it has a persistent advantage, so it will continue to grow. But essentially it is the growth of earnings.
Which again matter. But maybe a quality portfolio grows slower than a growth portfolio.
Yes.
Right? And so these are the different things which seem to drive growth. Drive returns in a portfolio. But you have to be aware that all three are there.
Right.
All three are there. And the focus should be on different aspects of it. So scientific investing tries to focus on all of them, right? Is aware of all of them, and we have to optimize for all. So you're not saying this is my favorite or that is my favorite, right? If you say favorite, then you're giving away some other source of earnings. And for example, very simply, like if you focus on growth, then your yields will be less, right? So your inverse of P will be low, or P will be very high. Plus growth is high, fair enough, it's higher than the market. And then the third is re-rating or de-rating. There, because you're entering at a high P, the chances of a de-rating is more and the upward re-rating is less, right? And so now you're completely dependent on growth being delivered. If the company doesn't deliver growth or fumbles even little bit, you have a huge de-rating risk, right? So this is the kind of analysis you have to do for each style, or anyone says that, okay, this is our framework, this is our process, then you apply this and you can understand how likely they are to continue delivering high returns or excess returns over different market cycles and different market conditions.
Right. So which you believe is more robust in terms of focusing, like as a element that one should target? Whether should you focus on yield, should you focus on growth, or should you focus on re-rating?
So good question. And see, we in scientific investing framework, we are saying all of this is a result. I have to first clean up the whole universe, investment universe, from the companies which are high risk fundamentally, right? Because of high debt or capital destroyers, eroders, imploders. You get rid of those. And from the remaining We want to invest in a portfolio of companies, diversified portfolio of companies, which is at a discount to its intrinsic value. When you do that, now we have nearly like a decade of model portfolio for the scientific investing, right? And the NAV series for a very long time with over multiple market cycles, right? Including COVID, including the Fed rate hike in 18, including Fed rate hike in 22, and so on. So that's one of the best empirical evidence we have. We can look at that. And what we have seen from that analysis is that majority of our returns, let's say 2/3 of our returns, have come from the re-rating part, and 1/3 has come from the growth part. And the yield is there, of course, something, but it's very, very small part compared to these two.
True.
Right. So for us, that becomes the most important. Historically looking, it is possible that in some other situation, growth is driving equal returns as.
So basically, this is a good point to highlight. The various. I think as a long-term investor, you have to always remain conservative. And what we have seen is that if you just focus on the yield, then obviously very high yield at times might have a lot of value traps in terms of they don't have a good outlook. Those businesses might not have a good outlook, and for a fair reason, they are actually mispriced, and their current yield might look high, while they may not be in a position to sustain even that the earnings that they are projecting or reporting as of now. So that is the risk. I think if you just focus on the yield, and even on the growth front, I think we have looked at the broader market in the last 20 years, and we have seen that majority, or rather 80 to 85% companies, which if you today categorize as high growth companies, they fail to maintain that high growth returns over, let's say, beyond a 5-year period.
Right, absolutely. I mean, we did the analysis for last 20 plus years, right? I mean, whatever we took all the high growth, let's say 20% plus kind of companies, growing at 20% plus for 5 years. And then we followed them up for the next 5 years. And 85% of those companies go down to like double digit 11% kind of a growth rate, right? So this is what we have seen over 20 plus years of analysis. So what looks like growth is usually not sustainable. With 85% probability, it's not sustainable.
So typically, a high growth portfolio might, come with a significant derating. Let's say 5 years down the line.
Yes.
And that's where the total return will be not that great. While I think on the value, like focusing on the re-rating part is, you can always price, you put the estimates in a very, very conservative manner. So you don't run the risk of whether the high growth will be sustained or high margins will be sustained. Let's say 10 years down the line. On the other hand, you can always put conservative estimates and then see that in the full market, are you able to find reasonably large 20-25 such opportunities to look at.
Right. Absolutely.
And that is a safer approach, so to say, a more robust approach to be able to continuously find those opportunities.
Absolutely.
And again, we have seen that those mispricing keeps on happening in different market cycles.
Absolutely.
Right? That's not, while growth might be closely linked to economic conditions, but mispricing is something that because of the various market focus shifting from sector to sector or
style to style,
that always emerges across market conditions.
Absolutely.
So great. So thank you so much for tuning into this webinar, and we'll hope to keep bringing such interesting ideas about investing, styles of investing to you.
Thank you.